All right, good morning, everyone. We're going to go ahead and start. This morning, we're going to have our public hearing on proposed regulations, deferred compensation plans of state and local governments and tax-exempt entities. It's REG 147-19607. The proposed regs were published in the Federal Register on Wednesday, June 22nd, 2016, and this will be our public hearing. The way this will work, we have a couple of speakers who have submitted their comments and outlines, so they will be speaking, and following them, we will have, we will open it to the floor. If anybody else wishes to speak, they can ask and come up and speak as well. We will give 10 minutes, but we also don't count the time that we're speaking, so we try to keep track of that. That being said, with the limited number of speakers, if you want to request extra time, that's fine. If anybody needs, by the way, to ever use the bathroom, you will need to have an escort, so please exit over there and grab an escort to use the bathroom, or otherwise go to the cafeteria or anything like that. You will need an escort. We're also, of course, being recorded, and there will be a transcript available. So. With that note, let's go ahead and get started. Our first speaker.
Thank you for your time today. I'm Kirk Sherman from Sherman Patterson. I was a second-year associate in 1986 when Congress extended Section 457F to tax-exempt organizations. I don't know whether it's bragging or if it's sad, but since then I've focused my practice in executive and physician compensation for tax-exempt organizations, credit unions, healthcare organizations, and associations. We've drafted thousands of benefit plans and employment agreements and severance agreements. From the few comments submitted on the 457F proposed regulations and the short line of speakers at today's hearing, the tax-exempt world seems quite pleased with the proposed regulations, and we agree. The softening of the regulations from what was announced in 2007 may have a lot to do with that. My purpose today is to address a couple of ways that we believe the regulations can be adjusted on the margin to facilitate understanding and compliance. And I divide my comments among three topics: the elective deferral rules, the treatment of loan regime split dollar, and the factors for evaluating non-compete restrictions. The elective deferral plan rules are clear when applied to a vanilla deferral. I elect to defer X% of my salary. Applying the rules to two other common plan designs is not as clear. The first of these is a plan where the employer provides supplemental dollars and allows the employee in December, before the beginning of the year, to choose a vesting date for those dollars, subject to a minimum, might be 2 or 3 years, and often with no stated maximum vesting date. We ask, is this an addition or extension of a risk of forfeiture after a legally binding right to the compensation?
Well, I guess if I can say, I did not understand this request, and that we have repeatedly said that the reason you would need to be paying for the extension is that there's no economic reason someone would elect to have to work longer to make the same amount of money or the same value of money. So it seems that that's exactly what you're asking for, is for someone to make the decision which is not economically reasonable based solely on tax reasons, which we specifically said was not what we wanted to do. So I guess I'm not understanding how that's at all consistent with anything we've done, either in the proposed regs here or in 409A or any of the other areas.
And we don't object to that result. It's just the wording of the regulation causes us to trip a little bit in getting to that result. I mean, we agree that if somebody could have the dollars in 2 years, but they elect 5 years, that's going to be an elective deferral from 2 years to 5 years. And the reason that we trip over this is the talking about the addition or extension after the legally binding right to the compensation arises. At the point, the money's always subject to a risk of forfeiture, so there's no addition to the minimum, but to the additional years, there would certainly be an addition for that, and we agree with that. The question can come up of when does the legally binding right to the compensation arise? A lot of plans say make your election participant before the beginning of the plan year, but it also has a provision in the plan that says we can amend the plan at any time prospectively. So that up until, let's say I make my election December 15th, on December 31st, the employer can still come back and say, by the way, we've changed our mind and we're not going to give you this deferred compensation next year. So I would say that that participant doesn't have a legally binding right until the point they get to January 1st and start rendering the services. And so what we'd propose in this to get to the result, what would help us in understanding those regulations is something like the language used in the elective deferral section to say that instead of, or in addition to initial deferral of current compensation, it talks about elective deferrals of compensation beyond the date the employee would receive them in the absence of the election. That would be helpful for us to understand this plan, this type of plan. The second one, I think we'll get the same response and maybe some additional question or comment, would be the so-called flexible benefit plan that has been out there for, I will say, decades, because it has been decades. There is far fewer today than there were originally, but still there are dozens of those plans out there. Now that's a plan where an employer will say to a participant, you can choose from among these benefits, none of which has currently taxable income. So it might be long-term disability insurance, long-term care insurance, and deferred compensation to simplify the plan. We would like, and so the question becomes now, similar to the first example, is this an elective deferral where the participant says, I will take the deferred comp?
I guess my first question is, what is your 125 analysis?
The 125 analysis is as soon as the proposed 125 regulations go into effect, we've got problems because the preamble to those regulations did talk about an election no matter when that election is made. And we think that would cover this type of election.
Do you think there's an answer right now, absent the proposed regs, under 125? So how would we answer? If we don't have an answer under 125, I'm wondering, or we do, which may not actually, which would come into effect why would we answer that now?
Well, I'm sorry, so the question is, why would you answer it now?
How could we answer 457F if the 125 question is either out there or would be answered in a negative way if it's finalized as proposed?
So you've got the dilemma of if we respond to this question under 457F, have we either allowed them under 125 or disallowed them under 125? Fair, and good, I understand that point.
Where we've looked at these and they raise issues across so many sections of the code. And in fact, we put out some chief counsel advice pointing that out, that we really have to coordinate across. And including in non-eligible employers, it would be 409A, it's going to be constructive receipt, it's going to be 125, right, depending on all of the different arrangements and all of the elections. But that's why it's hard to do piecemeal.
And we appreciate that. Our clients, over the years, we've had many who have been audited, our clients who sponsor these kinds of plans, and the auditors occasionally have raised the issue, but have never, but invariably, probably after speaking, and I'm sure after speaking with National, have come back and said, new rules are coming. When the new rules come out, you've got to comply with them.
Well, I will say this is one of the reasons we did ask for comments, which we are really due one on the leave plans, because honestly, we've seen it a lot with the use of leave and a mix. You can basically elect to use your leave for various types of benefits or otherwise have it cashed out. But that was one of the reasons we asked for comments there. Mm-hmm. That may be more of a state and local government issue than tax exempts. But we are trying to wrap our hands around all these abilities to elect the different types of benefits.
Yes, very good, and we'll look forward to. But in fact, what we were going to propose that would answer this question for us is the same answer as under the elective deferral for supplemental dollars. That if you elect a deferral beyond when you could have had the value of the benefit, so if you could have had disability insurance today, then that is current compensation, and electing deferred compensation is then a deferral. Of that money would be an elective deferral subject to the elective deferral.
Okay, we've also, though, I guess we were looking in some ways how the revenue procedure on constructive receipt and the need to make the election in the year before you earn the compensation rather than when you would receive the compensation. That's been a conservative place we've landed with some of the private letter rulings because it's conservatives. Would you be more aggressive than that? Is what you're saying. In other words, if I got a deferred benefit, I'd be able to make the election later?
And I'm sorry, are we talking still within the flex plan? The flexible
yeah, I mean, if I earned it this year, but I don't get, I get to choose, do I want retiree health or do I want deferred compensation, or do I want, so I'm not actually taking it currently. Are you saying they'd get to make the election later?
That's not, no.
Okay.
No, we're not.
So we're just looking at
saying
making
that.
it the year before you actually earn it and get it at kind of at the same time?
Yes.
Okay.
That's the, yes,
So that's been
the
our
focus.
dilemma, is kind of this disconnect sometimes between earning and receiving.
And I think the new regulations now, the proposed regulations if they go into effect as they are, would actually go a long way to answering that question as it relates to the deferred compensation elements of the plan. Particularly if there were an explanation, the additional language that would help us understand how that electing beyond the minimum, including current minimum, if you have choices of some current benefit, would apply. Moving on to, if I could, one more comment on elective deferrals. I was surprised just in the last couple of weeks, a very experienced, I would say well-known deferred compensation attorney was proposing a deferral plan for one of our joint clients, and it was an employer plan that had only supplemental dollars in it from the employer, 5% of salary. And the deferral would be, the vesting date would be age 65 or 2 years after the year that the money went into the plan, whichever is later. We said, well, with that kind of a design, then somebody who leaves at 65 will have 2 years of accruals that they will not be able to take with them because they will not have met the 2-year minimum vesting date. And so we suggested, why don't we just make it all cliff vested at 65, including the money that would come from 63 to 65, because these are employer dollars. This is not an elective deferral plan. And the provisions that he was citing for the minimum 2-year deferral were under the elective deferral plans. I recall back to an early private letter ruling. I should have looked up the number, but it was where the IRS said that it established and said you need a minimum of 2 years of service between the time the plan goes in and the vesting date, or the time the individual comes into the plan and the vesting date, to meet a substantial risk of forfeiture. And so they said a plan cliff vested at 65 is fine for anybody who comes into the plan before age 63, so that their service up till 65 would be meet the minimum 2 years. And that would apply even to the money that was deferred at 64 and a half. It was, again, supplemental dollars, non-elective. We get to that conclusion under the proposed regulations. But the fact that this, again, a distinguished attorney, raised this as his interpretation that the 2-year minimum applied to supplemental dollars.
I think I can see where the confusion lies, and in fact, I think that's something we may need to address more clearly in the regulations, in the sense that the 2-year concept of the 2 year as a minimum is really a safe harbor and an example in the Section 83 regs. In the Section 83 regs, if you had something that serially granted you property, such as stock, you would measure the 2 years from every grant. Now, we do have some PLRs that talk about ratable vesting, but we still measure from every grant. So I think what you're hearing is there's some confusion with deferred compensation. Is it the same concept that you measure it from every accrual or every contribution or however you'd want to express that? And that may need to be something we think about clarifying how that works.
That would be helpful, and we believe that allowing the deferral up to the cliff vesting date in those circumstances would be beneficial for a couple of reasons. Tax deferral for 2 years is not that big of a deal. Does that go on the public record? But the administration on that kind of a plan, if for people they have to say, okay, now when you're 63, we're going to stop paying you, putting the money in the plan, and we're just going to pay it to you in cash, it really becomes an administration challenge and a potential for just administrative errors that could lead people.
Right. I think we asked for comments also on what is substantial risk of forfeiture as far as being a significant services mean. It's something we haven't given a lot of flesh to in the past, as far as also not only is it 2 years, but do you have to be providing continuous services? Does it have to be what level of services? I think one thing, I understand your concern. One other concern, though, is we obviously wouldn't want someone to contribute money on December 30th that vests on January 2nd as a way to basically defer a year with no real vesting concept. So there is a need to kind of figure out why would that, as an initial and solo contribution, be a problem, but for instance, as the last contribution in a career-long plan, not be a problem. So
I think, in fact, the 2-year safe harbor that Stephen is referring to in the 83 regs is nowhere other than in an example in the 83 regs. So it's not set out as a rule even. It's simply part of an example.
One way to address this would be to do a similar example in the 457F side that had employer dollars going in, vesting at 65. Yes, that's a substantial risk of forfeiture if you come into the plan by age 63. Similar to that private letter ruling approach.
it'd be interesting. We'd have to deal with modifications and all of that. I'm trying not to build, it'll be interesting how we think about it. And if you have further suggestions, we're also open to comments after this. I don't want to build too big a cathedral of complications around, but on the other hand, I don't want you to be able to come into a plan at 63 and accrue all your money at 64 in 11 months and 29 days. Mm-hmm. So that, we have to,
Sure.
There's a whole, we'll have to think about, we certainly didn't, at least I don't think there was an intention to make a career-long plan's last 2 years vest immediately.
Okay. If I could then move to loan regime split dollar, I think it's a shorter discussion. As you know, under 409A, there's Notice 2007-34 that specifically or expressly exempts loan regime split dollar from 409A to the extent there is no provision for forgiveness or reduction, non-repayment of the loan. That's been very helpful as clients have considered loan regime split dollar, and to have that exemption, it has eliminated what otherwise would have been a lot of expensive and detailed legal analysis. I mean, it's just on a very practical level. That was very helpful. We have, we would ask that you consider the similar exemption under the 457F proposed regulations. And I do see my time is gone. May I have a little more? I'm almost done.
Yeah, you're okay.
Thank you. So finally, then my last point on non-compete restrictions. That snapping you heard in June was from all of the necks whipping around when we read the part that non-competes won't apply unless substantiated by the, unless certain conditions are satisfied. There we go. That was the language. We were fully expected, and our clients were prepped to no longer rely on non-compete restrictions as a tax deferral mechanism. That's not to say they would have gone away under the deferral plans. They just no longer would have been relied upon for tax deferral. And the reason is a deferral plan and a non-compete in a deferral plan for the employer is the single most efficient way to protect the employer from non-compete, from unfair competition. The reason is, for the employee, from the employee's perspective, without that forfeiture provision, the employee starts to calculate, well, will the employer invest the legal proceeds, the legal expenses necessary, and potentially the public reputational risk of suing me to keep me from competing? Or can I, am I going to be safe to go through? It's kind of an interesting calculus that executives and physicians go through all the time. But if you have a deferral plan with a nice pot of money in it that says, if I go across the street and work, I lose X dollars, then it's very easy for the executive to understand the cost of competing. From the employer's side, there is nothing easier to enforce the non-compete restriction than simply not writing the check for the benefit, instead of having to invest in the lawyers and the potential negative publicity that comes with that. So we are all for non-compete restrictions in the plans, even if they were no longer available for tax deferral. And many of them won't be because of the higher bar. But that's fine, and we'll continue to see them in the plans, we believe. The last reason for including them is in states like California or Oklahoma, where the state prohibits non-compete restrictions. In a benefit plan, in the broad ERISA preemption, employers are able to get that protection because the ERISA law of non-competes would preempt the state law. So it is valuable, and it will continue to be there. Our sole comment about the non-compete testing provisions is with respect to the financial need element. Over 30 years of watching executives and physicians, and those who've competed and those who haven't, net worth has little correlation to indicate who's at risk of competing. Integrated Healthcare Strategies from Gallagher recently did a study of their CEOs, and 307 of them. There is an aging population of CEOs. The Masters of Healthcare Administration is not producing enough people to come in and fill the ranks, and so there's a problem. And with this aging group, of this group, nearly half, 48%, are over age 60, and 12 of them are between 70 and 80. Many of these are people who came out of retirement because the employers had a leadership void and needed transition leadership, or because the CEOs, frankly, needed to be relevant again. And so they found that retirement wasn't suiting them. These are very wealthy people, whatever wealthy means. So they're not competing. They're not re-entering the workforce for financial reasons. They're entering for personal, strategic, some might even say charitable reasons. So the other aspect or the problem that we see with financial need is that who's going to be the arbiter of what is financial need? Who's going to decide when an executive no longer needs the money or is not in a position to need the money to compete? And who's going to be the one to sit them down and ask, now show us your balance sheet, show us your assets, what are your liabilities, what's your cash flow needs? Those are discussions that just won't happen. And so we would encourage, we love the high standard, we love the individuals, focusing on the individual's ability to compete. We think that eliminating the financial need criteria would actually be very beneficial and help for an easier administration of the plan.
And I think we were looking at knowledge that the employer would have. For instance, is this an older person with a particularly vested SERP, for instance, in comparison to a slightly younger person with no significant retirement benefits coming out of the employer? Would you say, even with restricted to that type of knowledge, that it's not a factor to be considered?
I would, just because the turnover among CEOs is fairly high. I don't know exactly what it is. Where you accumulate a SERP at one employer and then go on to another employer. And so the current employer may not know what has accumulated from all of the other employers.
I guess it's interesting, where we've seen a lot of cases is not at the CEO level. It is at lower levels where non-competes were being basically signed off on, not followed, not used. And we were wondering whether the fact that these were mid-level people without significant benefits, retirement-type benefits, are being eligible for payments under them, would be a significant factor in thinking this person may need to go compete, as opposed to someone who is truly retiring at a higher level. So I think that's where we were coming from in our experience with cases we'd seen, which had basically blanket non-competes with choice of term.
Yeah, that's interesting. As we were reading it and viewing it, we really limited it to the top really few people, as even those who might even be considered as qualifying for it, because frankly, Vice President of Human Resources going to across that may hurt, but no more than turnover of if that person left anyway versus if they go across the town. That's not going to hurt the employer. It's not going to be a substantial employer economic interest.
Right, but I think people were actually saying, don't worry about it. Just if you want to defer, sign the non-compete and say how long you want to.
Oh.
That's why we were trying to come up with something that at least took into account, if you really know these people are going to need to continue their career, probably need to continue their career unless they're otherwise independently wealthy. Should that be a factor? And
I can see on the margin in that situation, yes.
So I think we're coming at it from two different experiences. So, but I do agree we may need, especially that what we intended was limiting it to the types of information the employer would otherwise know. I don't think we intended for people, and we have gotten this question, that really have to sit down and discuss people's personal financial information.
Yes.
So yeah, definitely. But what this is trying to get at is the type of situations you're actually talking about. So we'd appreciate any comments, which is, this is someone who is likely interested in competing and could damage this institution, and we will track and we will know if they're competing. This is not intended as a tax deferral tool that people will understand that they can cancel at any time and otherwise get paid when they choose.
Right. Yes, okay.
We're trying to come up with a way to differentiate the two types of situations.
And I think the rules, actually, the proposed rules go well down that path from what they've been. And so I think that's a significant improvement, but we'll continue to think about.
My last thing, if you can just remind people, because people used to say, well, non-competes work under Section 83. We always remind them the proposed regs have a presumption against them working, and you have to rebut that to actually work. So it's been interesting in this field when we've come out with these things, how we get but non-competes work under 83. So little misnomer.
Is that a glass half full analysis? I'm not sure. Empty. Can I plead the fifth on that?
And thank you for is that how, by the way, we've also gotten comments that people are able to use forfeiture provisions despite in states where they cannot be enforced as true non-competes where they can't compete. Is that the analysis people are using? Is it only when they are agreeing that it's an ERISA plan, or is there some other way they're able to enforce the forfeiture provision without, for instance, getting injunctive relief?
Right. It's only the ERISA preemption that I'm aware of.
Okay.
Yeah, and you may be aware there's case law in California and Oklahoma on that supported that position.
Great. Thank you.
Thank you for your time.
Our next speaker.
Hello, I'm Jim Patterson from the law firm of Sherman Patterson. You just heard from my law partner. I'd like to start by thanking the panel for having this hearing today and for the time spent by the IRS and Treasury in developing the proposed 457F regulations. This morning I will share thoughts on 4 topics. First, grandfathering. Second, operational and documentation compliance effective dates. Third, the more than 125% standard for elective deferrals. And fourth, bona fide severance plans. So first, grandfathering. In my written comments, I recommended the IRS clarify the impact of the final regulations on deferrals that occur before the effective date of the regulations. The proposed regulations provide that the new rules will apply to new deferrals. There's no confusion there. The guidance then provides that those amounts include, quote, deferred amounts to which the legally binding right arose during prior calendar years that were not previously included in income during one or more prior calendar years, end quote. That provision has created confusion. In preparation for this hearing, I reviewed about 20 summaries from industry commentators and found that they were divided almost equally into 3 camps. Those who believe prior deferrals are subject to the new rules, those who believe the prior deferrals would be subject to the law in effect when the deferrals were made, and those who recognize the confusion or cited the language in the regulation, in the proposed regulation, but did not interpret it, likely because they weren't sure what it meant. Our law firm actually showed up on 2 of the lists. We initially thought prior deferrals would be subject to the new rules, but on closer review changed our view that the law in effect at the time of deferral would govern those amounts.
Well, let me go through the way I read it and let me know where I'm missing something.
Sure.
Because this says they apply as of the date they're final, is the general rule.
I'm sorry, that they apply when?
As of the date we adopt final rules.
Okay.
So they would apply in the year that you have final rules.
Mhm.
So if we made this 2017, it would be 2017.
Mhm.
Including deferred amounts to which the legally binding right arose during prior calendar years. So those would be calendar years before 2017 that were not previously included in income during one or more prior calendar years. So you haven't already included them on your 1040. We're not going to double tax you.
Mhm.
What's unclear?
It's unclear whether you're referring to prior deferrals.
Well, wouldn't that be amounts to which a legally binding right arose during prior calendar years that were not previously included in income. How is that not an amount? I mean, I'm not understanding how that's not an amount. I understand there's a wish and a comment to get it, for that to be the final effective date rule, but I'm not understanding how this is unclear as to what we were proposing. So we can just move on in a way. I mean, we can always adopt what we want, but I've read this, and I think there's a wish to try to interpret it to not cover those amounts, but it specifically says it will apply as of the date, and it will apply to deferred amounts to which the legally binding right arose during prior calendar years that you haven't already included in income.
Yeah.
And I think, for instance, one of the things we're afraid of is we did not want, after these proposed regs came out, if they said they were effective only as to deferrals after final, people would stuff. Why not? You would start deferring everything right now to try to get under what you think was the position prior to the final regs. So we don't want stuffing. So I can't, we have to deal with stuffing.
Okay.
I also, given some of the aggressive positions we've seen taken in 457F, we weren't entirely comfortable saying that was a free pass, and unfortunately, I think that's how some people may interpret the idea that the final regs only apply to amounts after the final regs, is that somehow we're giving a free pass, and there's no, we were not giving a free pass.
Right.
I'm just letting you know the concerns that led to that particular provision.
Okay, but it sounds like when I talk about our two interpretations, that our first interpretation is your belief rather than our second interpretation, that those deferrals made before the regulations were finalized would be subject to the law in effect at that time.
Right. We won't pick them up in a year before they're finalized if they weren't otherwise subject. I mean, I can't say pick them up. They won't be subject to the final regs for years prior to the years the final regs are published. So they won't be retroactive to open years and cause you to have, on the other hand, as of 2017, the way this would read, if that's when we go final, all your amounts deferred, no matter when deferred, that you haven't otherwise included in income, if they are vested under the final rules, would be vested in 2017 and need to be included in income. Okay. That's what we have proposed.
So we would say, so we think the laws, as I mentioned, we think the law in effect at the time of deferrals should control. Retroactive tax law creates unfairness for taxpayers who made decisions based on the law and guidance at the time, especially...
Given our notice that we said what we were going to do and that this isn't nearly as strict as our notice that was 7 years ago, what are people doing that we need to be worried about that they would be unfairly treated as vested in 2017 that they were? I mean, what is it that they were doing?
Say for instance, perhaps an elective deferral plan, and maybe an election that was made 15 years ago, where there were private letter rulings at the time. There was discussion by the IRS that why would somebody defer money? Why would they do that and think that it could be subject to risk of forfeiture? Well, there were letter rulings out, and still are, that this was a practice, this was done. And so you may have someone who electively deferred amounts 15 years ago that now would become taxable if they didn't follow the rules now that say that there needs to be a greater than 25% match on those amounts.
Well, technically, if we didn't grandfather, all we would be saying is that there are no regulations that apply to that, and I can't say we'd necessarily be agreeing that they weren't taxable before. You're leaving just them open to whatever the state of the law is today, without reliance on the proposed regs. So I also worry this is not meaning to say grandfathering doesn't mean that they're not subject to tax. It means they're not subject to the regulations.
Okay, sure. There is, if it's not the proposed regulations or the final regulations that they would be subject to, it would be the tax law in effect at that time, and perhaps the service says those would have been taxable anyway.
So I think for many years we've been saying elective deferrals just elective deferrals without anything else would be subject to taxation on deferral. We've been saying that for many, many years.
Okay, thank you. Second point, operational and documentation compliance effective dates. Our law firm of Sherman Patterson works with, among other clients, approximately 600 tax-exempt hospitals and credit unions of varying sizes, ranging from small $20 million credit unions to large billion-dollar credit unions and healthcare systems. The limited scope excuse me, of 457F of the code lends itself well to the development of boutique law firms like ours that focus on the executive and physician compensation needs of tax-exempt employers. I recognize as I discuss operational and documentation compliance that our views are at least somewhat self-serving, as we will have a lot of work to do when the regulations are finalized. We also represent various consulting firms who have hundreds of tax-exempt clients who similarly have a strong desire to have time to respond to the new rules. Exempt organizations themselves, however, need sufficient time to analyze and respond to the new rules. The timeline for a typical organization that will modify its plans to comply with the new guidance will be along the lines of attorneys review the final rules when they are issued, addressing open issues informally amongst themselves or perhaps with the IRS directly. The attorneys then make contact with their consulting clients, let them know how the new rules work. The consultants review their plans and determine which plan designs will work going forward and which plans for individual clients need to be revised. The consultants reach out to boards of directors of their tax-exempt clients with this information. The boards meet to revisit their objectives for providing deferred compensation, discuss their options, and then review and ultimately approve a new plan design. The boards communicate this new plan design to the executives or outside organization that assists the board in administering the plan. The employer develops communication materials such as plan books to help the plan participants understand changes to the plan. They may meet specifically with executives and talk about the changes that need to be made. The administrator, the board, or the consulting firm circles back with the benefits attorney to request updates to the plans. After reviewing the drafts and making any necessary changes, the board executes the new plan documents. Even in cases where consulting firms are not involved and where the tax-exempt organizations use local counsel to assist with the design and documentation, the process is still time-consuming. I believe that an orderly transition in most cases would require 6 to 9 months at a minimum. Therefore, I encourage the IRS not to attempt to issue final rules this year and have them take effect January 1, 2007. Rather, a much more orderly approach would be for the IRS to issue the final rules in January or February 2017 with an effective date of January 1, 2018. If publication of the final rules is delayed beyond March 2017, then ideally the effective date would be deferred to January 1, 2019. As you know, the industry has waited 9 years to get this proposed guidance, and the guidance is different than that which the IRS originally anticipated giving, which we're very happy about. But I believe that both of those factors further support an orderly rather than rushed rollout of the new rules.
And I know we've talked about the non-compete, but what specific changes as to current plan operations that you would possibly agree wouldn't lead to taxation under 457F, which isn't really compliance, it's a tax timing rule because you can't really comply out of it. You're going to either have a non-vested, it's a vesting timing. But what exactly are the changes that are problematic?
Well, so elective deferrals, we need to understand those and understand how plans with prior elective deferrals need to be revised. So that's a big issue. There are a lot of plans with elective deferral components that would need to be revised. We need to understand what the new rules are. And
these are elective deferrals with no match or no other contribution. And despite the fact that we've said for years that we don't think that works, we should do what?
Give the industry time to respond to the clarifications in the final regulations.
But if we said they already had to be included, which would be our position in prior years, what would we be doing by grandfathering that?
No, not grandfathering. Not asking for that.
Right, but I'm just saying if your current, I guess I'm not really understanding where this is leading in the sense of, are these plans that you are saying currently have elective deferrals with no match and need to instill a match?
Potentially, yes.
But then wouldn't they have had, our position would have been they had income inclusion all along on their no match elective deferrals, and then you can just implement your match.
And you're saying that's been the position of the service for decades?
Well, it certainly has been for the last decade.
Mm-hmm. Yeah, that's an area where perhaps we have a different view on what the service felt in looking at private letter rulings and looking at just, I don't know, client audit experience where they looked at that specific issue. but specifically letter rulings and practices where elective deferrals were allowed. Court cases that addressed those. Those are things that we've relied on in our practice. And so yes, I would say that a plan like that would still take some time for the attorneys, the advisors, the boards, everyone involved to analyze and to revise according to additional guidance that we receive.
What's the typical timeline for that? And you mentioned the process from the beginning to the end. Is it 9 months, 6 months?
It's more than 6 weeks or 4 weeks. I don't know. It depends on the size of the organization, the complexity of the benefit plans, the situation. It is different for each organization. But I would say for no organization would say 4 weeks be sufficient. I don't even know that most boards meet within that period of time. So if the service finalized regs at Thanksgiving, for them to take effect 5 weeks later would be very difficult. Yes, thank you. So as to the timing of compliant plan documentation, I can't help but think back to the 409A days. Shortly after our firm completed documentation required under the proposed 409A regulations for hundreds of clients, the IRS issued final regulations that required more revisions to all of those plans. I appreciate that the IRS is not requiring updated plans until the rules are finalized. But based on the timeline we just discussed, I still suggest the IRS give the industry significant time, even 12 months from the operational effective date of the final 457F regulations before documentation compliance is required. Again, there are processes that need to take place for the actual documentation work to get done, to be designed properly, and to be approved and signed.
So you would have I guess I'm not understanding in the sense that you would have vesting rules, but even though they would vest under the plan document, they wouldn't vest because 6 months later you will be amending the document? Because again, this isn't compliance in the sense of 409A about timing of payments and things like that. This is all you're really talking about is staying out of 457F by staying deferred and by staying subject to a substantial risk of forfeiture. So it seems that you either are or you aren't under the terms of the plan. And what are you saying? Someone would vest under the terms of the plan, but you would be amending it later to say they didn't?
I'm saying that that once the rules become operational, that let's say that there's a 6-month period. I'm saying that that I believe it's a stretch to believe that the documentation can all be updated within that same period of time.
But we're only talking about vesting. We're only talking about vesting. So if we're talking about vesting, maybe how do you say that you're operationally putting a vesting condition into place if it's either legally the vesting or not? Are you communicating it to them and then they will actually forfeit if the condition happens, or are you not? Because I'm kind of not understanding if they're not bound by something in writing.
Yeah, I
understand
understand
the forfeiture condition.
I understand your point. Perhaps the better request from us would be give more time for operational and documentation compliance and make them occur at the same time. I understand the point you're raising. By dividing out operational compliance and documentation compliance, I'm just trying to point to the practical realities that companies have to do what you're asking them to do.
It's going to be a big weighing, I think, because the other issue we've had is some people very much pushing the boundaries in the world of no regulation. So asking us to allow people to continue in that vein, looking, and especially in some type of grandfathered mode, is also problematic. So I can understand where you are not one of the more aggressive players and you just want to bring things, maybe need to make some slight modifications. On the other hand, we don't want stuffing and for people to interpret or think we are implying that somehow the more aggressive practices were working and that's why we would delay the effective date. So it's also a problem for us that we're not changing from a defined rule to another defined rule, which makes life a little easier. We're kind of in this gray area, we all don't have a meeting of the minds
Right.
necessarily, and how do we cope with that? But I think your points are well taken, especially for those less aggressive and folks just trying to follow the rules.
Okay, thank you. Third point is just a perhaps a tedious request, the more than 125% standard. We appreciate that the IRS has fleshed out the meaning of the materially greater standard, as set out in 49A, for additional or extended substantial risks of forfeiture to qualify in deferring taxes. I also understand that when a line is drawn, there's always something right below the line that doesn't qualify. However, I recommend changing the more than 125% of present value standard to at least 125% of the present value. 25% is an easy target to understand, and I suggest the IRS avoid the need for what I saw in a recent document said that with elective deferrals, that there would be a provision required of a match of 25% plus $1.
Yeah, you're not alone in making that comment, so it's well taken.
Okay, thank you. Finally, last point, bona fide severance plan. Competitive severance arrangements will at times exceed the 24 months of annualized compensation that the proposed regulations allow to qualify the plan as bona fide. I believe the 24 months of annualized compensation limit is another helpful line in the sand the IRS and Treasury have drawn. I simply suggest that the IRS follow the 409A separation pay standard and clarify that a bona fide severance pay plan is the severance pay, or as 409A clarifies, the portion of the severance pay that meets the 2 times annual compensation and timing requirement. This would mean the first 24 months of severance at the annualized compensation level would be treated as a bona fide severance plan, assuming the other qualifications are met, and any excess would not. I believe an example similar to the one provided in our written comments would be helpful. Also, employers often provide guaranteed severance, followed by additional severance if the executive has not found other employment, or a similar design with full severance stated at the outset, but a portion of which is subject to offset if the terminated executive finds subsequent employment during the severance period. In these designs, the full extent of the severance benefits is not known at the beginning of the severance period. I recommend the IRS clarify in the regulations that the portion of the severance period that is subject to offset not be taxable until it is actually paid, assuming the bona fide severance plan exemption does not apply.
But I just find that confusing because it seems it's the individual's decision whether to take the other employment or not, while substantial services may, also is a decision whether to stay or not. We normally, outside of this providing substantial services, don't put forfeiture conditions, make them completely in control of the employee. So here, the employee has complete control over whether they take another job or not, in some sense, as opposed to the employer doesn't have any influence on that. So it also doesn't fit normally our condition related to the performance of the services. How does whether they perform services or not for another organization relate to your business and your business goals? So I'm a little confused on that one. I can understand that they would need to get an offset for any amounts that they aren't actually paid because they've chosen. Mm-hmm. But why would we treat that differently, for instance, to some type of termination for cause or other non-substantial risk of forfeiture condition if, in fact, the employee is in complete control of whether they forfeit or not? Mm-hmm. It seems anybody could put it. You could put it in, somebody could leave at 80 and you could say if you get another job within the next 5 years, there'll be an offset, and then they would just, automatically they could choose whether or not, and that would be offset through the, I just worry that seems particularly subject to abuse in certain situations especially.
So, yeah, I understand the point that you're making there. What we would recommend is that the IRS clarify in the regulations that the portion of the severance that is subject to the offset not be taxable until it's actually paid, assuming the bona fide severance plan exemption does not apply. So
but the only way to do that is to say it's not subject to a substantial risk of forfeiture. But what's the substantial risk of forfeiture?
So in this case, if the plan has a design where they get 24 months of severance and then they'll get an extra 6 months if they're still unemployed, so that then at 24 months, they determine they have terminated employment at that point. That the taxation of that benefit the impact of it be addressed at that point, rather than tax them on the front end.
Oh, okay, you just want them taxed at the end of the 2 years.
Right,
I
rather
see,
than
okay.
at the beginning,
But
where,
for anything past 2 years, I thought you were saying you wanted that, so you both, you want that ability to pay after 2 years and still have the 2 years be out, but you also want it, what's after 2 years out until the end of the 2 years.
in a plan design like that, we think it would be a favorable position. We think it would be a reasonable position for the IRS to take. Severance is all about these severance plans and the way they're designed. We look at it not just from the participant standpoint, as you are, but from the employer's standpoint. And the ability to provide competitive severance, to be able to have the right people doing the right things for the organization, we think that there is merit to that. And if a severance plan is designed the way that I described,
Well, it seems that's just mean, it doesn't have anything to do with the services there, you just want to pay less severance if they have other sources of income. Well, I don't understand how that has anything to do with their performance of services at your organization.
so our position, I'm not sure if this answers your point, but our position would just be, rather than tax them on the front end, if they don't actually end up getting the severance because some of it is offset, that they not be taxed on the front end and then have to rely on the miscellaneous itemized deduction limitations where they might not be able to get that money back. It may just never be received. So it seems like a fairer approach to address those plans differently. If there is so maybe it's similar to the present value rules that the IRS addressed in the proposed regulations, that if we look at what the projected value of the severance would be in a design like that, could we use that as a rationale to say, we're not sure this is going to be 30 months of severance. It may only be 24. And so our position would just be, with plans like that, we think that there's a reason in the market to have them. We see them, and it would be a reasonable position to treat those differently than a plan that provided a guaranteed 30-month or whatever period of severance.
Okay.
Well, that's it for me. Thank you so much for letting me present these thoughts. And do you have any other questions?
No, I know I've been a little pointed, so thanks, guys.
Thank you.
Thank you.
Thank you.
Is there anybody here who, we're opening the floor if anybody wants to speak? Oh, you got to get up to the mic to get recorded. It's a public hearing. We need to be recorded. And you do need to identify yourself. Thank you.
Hi, I'm Norma Sharara. I'm here today in my personal capacity, not in my official capacity. I had a question with respect to the -11 regs, where there is a definition of disability and a definition of involuntary separation from service, which includes good reason. Those terms are used in the -12 sections of the regs. For example, in the -12 section, it says, if you have a rolling risk of forfeiture and you want to push it off, it has to be pushed off at least 2 years, except if there's a death or disability or involuntary separation from service. And I just wanted a clarification that the definitions in -11 section of the proposed regs would apply in the -12 section of the regs.
Well, if we haven't made it clear, we'll take that as a comment that we need to clarify that in the final regs. So,
Thank you, that's all.
do we have anyone else who would like to speak? All right, with that, that closes our public hearing on proposed regulations. I'd like to thank our speakers, and thanks everyone for attending.